So let's get some two brilliant experts, regardless of their skin color or their race or their ethnicity. And I'm quite serious about this. I'm so angry at that story. Joining us now, former Reagan economic advisor and Presidential Medal of Freedom recipient, my dear friend Art Laffer, and Scott Minerd, Guggenheim Partners Chief Investment Officer, distinguished economist and Fed watcher. Gentlemen, thank you. I'm not going to apologize for my opening riff. It's nothing to do with Fed policy, but I want to get it off my chest. Scott Minerd, you wrote a terrific piece that the Federal Reserve should not be controlling interest rates, but should be operating through their balance sheet, something they actually control. And I just thought it was spot on. Arthur has said similar things. Steve Forbes has, I have. Scott, walk us through your conception. What should Jay Powell be doing instead of trying to cook up interest rates?
Well, Larry, thanks for having me on. You know, any elementary understanding of monetary policy says that inflation is always and everywhere a monetary phenomenon, which is we can credit to Milton Friedman's work. And so it's really about how much money is in circulation versus how many goods and services are being demanded. So the idea that we're going to adjust interest rates but not shrink the balance sheet, or that we are going to adjust interest rates and shrink the balance sheet, is really introducing a much too complex approach to dealing with the policy. The reality is there's too much money in the system. We need to start shrinking the balance sheet. Let short-term rates find the market equilibrium rate. Forget this idea of pegging interest rates or setting, trading ranges. This is the stuff that we did in the 1970s. And as a result of that policy in the 1970s, nobody knew where the true equilibrium rate of interest was. And so therefore, we continued to be way too accommodative, and it turned into, the inflationary spiral that we saw in our youth. And so today, there's a wonderful opportunity here. Inflation is high. Start shrinking the balance sheet. Let the market do its own thing and stop trying to say, I'm smarter than the market. I'm going to tell you what the overnight rate should be.
Yeah, amen to that. Art Laffer, it's just so weird. So here's Jay Powell saying, well, we've quote, tapered the balance sheet in the last couple of months. They're still going to buy bonds. What are they going to buy? 60 billion, then it cuts to 30 billion. Part of those they're actually still buying mortgage-backed bonds. Home prices are through the roof. They're still buying mortgage-backed bonds, which is really one of the stupidest things I have ever seen. But coming to Scott's important point to deal with the problem, there's too much money. This is a Friedmanite kind of situation. It's not so much that the dollar's crashing, it's that the government's spending so much money and the Fed has enabled it and accommodated it by financing it with all this excess money. So Scott says shrink the balance sheet. They should start right now, not wait another month or 6 weeks, right now, and let interest rates be what they may. Arthur, what you think about that?
Well, I think we should have done it 2 years ago, Larry. I think Scott and you have been right on bad, although I think Scott's hat should be tilted backwards, by the way, just for the record. But we should exactly
do that. Don't do it, Scott. He looks great this way. You look great this way. Don't listen to Arthur. Look at Arthur. I mean, he's giving you fashion advice. I'm sorry. Go ahead, Art.
Well, I'm so cool and up straight. But hey, the Fed has been complicit in this deficit spending by the Congress and by the president. It's got to stop. They can't sit there and underwrite it and become the buyer of last resort for all debt. They should just get out of there. I think a lot of the reason why we have all of this spending and all of these problems by transfer payments is because of the Fed's willingness to underwrite anything the federal government does. It's just what they did in 43, I think it was, to 51 before the Accord, and it led to a lot of dislocations. It's the same policy as the two of you have suggested, but frankly, I think it should have been done a long time ago, and if not then, it should be done now. And then, as Scott says, roll off. Instead of replacing the bonds that roll off and get retired, just roll them off and shrink that balance sheet right with that. The debt of the Federal Reserve is very short-lived, which means that'll roll it off very quickly. And I think that's the right thing to do, and just let the markets go where they will.
Arthur, in your writings, years ago, you said this, that they should control the monetary base and not interest rates. And we all call it the balance sheet now. It's basically the monetary base construct. That was the conception. Look,
exactly.
The rates have already risen. I mean, the 2-year note, which was about 20 basis points at the end of the year, is now, I was talking to Conrad DeQuatros, at today's closing, Scott, is call it 1.1. It's 113. So it's up 100 basis points. That means, to me, the Fed funds rate should be up 100 basis points because that's where market rates are going. The 2 years of the 10-year, which had fallen to about, 135, 140, that was up big today. It's 184. I think it's going to 3%. But the point is, I don't know. I don't think you guys know. Jay Powell doesn't know. The Federal Reserve models don't know. What they know is their balance sheet is way too much, supplied way too much money. You couldn't have 7% inflation without excess money growth. So he's got this story. But, Scott, I don't want to pick on Jay Powell per se. It's an institutional thing. The Fed wants to control everything, and they really can't. And I think you're giving them a way out. This balance sheet shrinkage gives. And by the way, it's been estimated. Somebody was telling me today we're about $3 trillion too much money on the Fed's balance sheet. About $3 trillion. Now, there's models that can get you there. But anyway, that's the point. So work on that for the next year or two.
Yeah, I would agree. I mean, to Art's point, can you imagine where long-term interest rates would be today if the Fed had not accommodated all the spending out of the federal government and bought the bonds? And this is exactly the same kind of stuff that went on with the Great Society. It's the same thing that went on with the Vietnam War. It was the same thing that went on with the Second World War. And it always leads to inflation. And so it's this expansion of the assets on the balance sheet, which you correctly pointed out is nothing more than the monetary base. And if we would control money, I have a lot of faith in markets. And nobody is smarter than the market. Let the free market determine where the rate of interest should be, because as the interest rate moves up, what will happen is that we'll see some kind of response in prices. Eventually, if rates keep going up as the balance sheet shrinks, we'll start seeing prices slow down and actually the rate of inflation declining. And why should I assume that I know what the right rate is for the overnight rate or the 2-year note or the 10-year note? I think it's an insane model that we're using, and candidly, the hubris here is unbelievable.
Arthur, there's another point I want to make in terms of a model. Okay, I'm going to go back to the Laffer-Mundell model years ago. If you're going to deal with inflation, you have to boost the value of our money. You have to reduce the supply of money. In this case, they kind of march together. But, Art, one way to make it an easier adjustment on the economy, I'm going to suggest, would be to cut taxes, whereas Biden is raising taxes. So here's the deal. Biden, whether wittingly or not, I have no idea what he knows anymore, but I'm just saying his policies would raise taxes, and he does support some tighter money. Now, Art, to coin a phrase, that's root canal without Novocaine. Reagan, on the other hand, cut taxes while Volcker was strengthening the dollar and curbing inflation. Which do you prefer, and why aren't they doing it?
Let me just say that with the inflation we have right now, and with the capital gains statutory tax rate we have right now, we have raised the capital gains tax rate dramatically, Larry. If you look at interest rates right now as paid by the Fed, and the Treasury through the Fed, real interest rates today are about -5.25%. We are paying the government to lend money to them. When we came into office, Larry, back in the day in 1980-81, Paul Volcker reduced the rate of growth of the monetary base, exactly what Scott was suggesting be done, and the interest rates in the U.S. went up to 21.5% was the prime interest rate the day we took office on January 20th, 1981. They cut taxes dramatically, and we got the biggest boom ever. My suggestion is the Fed reduces its balance sheet and that we have a payroll tax cut to bring people back out of the semi-retirement and bring them back into the labor force to increase output, employment, and production, and stop buying the government bonds and underwriting profligate spending. That's my solution, and I think the two of you would agree with both of those.
I totally agree. I'm just saying it's like a totally different model. And
total opposite.
Right, opposite. It's interesting, you know, Scott Minerd, it's interesting. We've been covering this on this show last night, certainly, and more. The states are cutting taxes, okay, and Biden wants to raise taxes. The federal government wants to raise taxes, but all the states are cutting taxes. Well, guess what? The states are smarter than the federal government. And they may not realize it, but in Arthur's model, which he shared with the great Robert Mundell, the late Robert Mundell, that would make it easier, all right? There's going to be some economic pain here. You know, you make your bed, you're going to have to sleep in it. You make your easy money bed, you're going to... But I'm just saying, Scott, while the Fed is tightening and taking the punch bowl away, to use an old phrase, why not cut taxes? Why you create incentives? They'll pay for themselves, and it'll make life a whole lot easier so we don't have to go back to 10 or 12% unemployment, which we might do the way this thing's going.
Right. Well, you know, it's interesting, Larry. I looked at some numbers the other day, and Art would be very familiar with these. When the tax cut went through in the prior administration, the unemployment rate among minorities reached a historical low. Today, that even though we're basically back at the same unemployment rate we were at the bottom, at the trough of the last cycle, the unemployment rate among minorities today is twice the level.
Yeah, that's a good point.
Okay,
that's a key point.
There was
it may get worse.
There was a massive corporate tax cut. And isn't it amazing, if you cut taxes on producers of goods, they will hire more people to raise production because their profitability goes up. I don't understand why we go to something.
I got to get out. Everybody's yelling at me. By the way, to Arthur's point, we should index the capital gains tax for inflation. We've never gotten around to doing that.
Period.
By the way, Nancy Pelosi made a fortune. You know, she is the greatest investor, stock picker in modern time. She made a fortune on the capital gains of the 5 big tech companies, but this is before she raised the capital gains tax or wanted to, and before the big inflation hit. Now, ordinary folks are going to get clobbered by inflation, so that's just another thought. Gentlemen, thank you. I appreciate it.